So joining me now is Benjamin Lau, Chief Investment Officer at Aprium Advisors, a member of this year's CNBC Financial Advisor 100 list. We've been featuring a lot of you folks out there on the financial advisory side because we want to know what clients are thinking about the current market and what the outlook is. So maybe the big first question to you is this a market that makes you fearful or optimistic?
Well, right now, they're short term. We're a little bit cautious right now. We think the market is probably pricing too optimistic of a Powell pivot soon. So we think right now probably is a good time to short some cash balances for many of our retired clients.
Now, when you say short cash balances, you mean solidify them, maybe even build them, get that dry powder, so to speak. Where exactly are you raking some of that money, the cash? What are you selling to kind of raise those levels for down the line when a better opportunity arises?
Well, because so many of our clients do take out money for living expenses, we're taking money out of some of these high beta technology names, shorting them into cash, U.S. Treasuries, even some investment grade bonds.
So if that's the case, if it's Treasuries and investment grade bonds that you're kind of raking some of this money into, what exactly does that mean then about what you're looking for before that cash gets redeployed again?
Well, I'm looking for earnings to really come down a little bit more, right? We still haven't seen an earnings recession in the S&P 500, right? Earnings are still relatively solid up until now. So that PE is still relatively high. And if that is going to come down even more, PEs can even rise even higher. So that's what we're looking for. We're waiting for earnings to settle down in the market before really jumping back into the risk side of things.
Is there, you mentioned technology, the high beta, more high volatility names that you are a little less attracted to these days. What exactly then, if you were to put a shopping list together, what goes on it right now? What parts of the market do you find could be more opportunistic in this current environment?
Well, look what you're seeing earnings, right? Look where you're seeing revenue growth and earnings growth in the S&P 500. Right now, the name continues to be energy. Energy is still the hot sector, and as long as oil prices remain elevated, I think a lot of these American frackers can still print money, right? They really brought down their cost of capital, they restructured their balance sheets, and I think they're extremely profitable enterprises. Other things we're looking at are companies that are really exposed to the CapEx cycle, right? CapEx is still remains strong, surprisingly. So businesses continue to spend to really earn the extra middle income.
Now, you mentioned before the bond trade. I'm looking at 2-year Treasury note yields, the shorter duration, shorter maturity side of things that are currently yielding around 4.5% or thereabouts. Meanwhile, you've got 10-year Treasury note yields that are currently just around maybe 3.8%. The yield curve remains inverted, those short-term rates higher than long-term ones. How attractive is it for you and your clients to be putting money into the short-term Treasury side of things because it is yielding so much more than other parts of the yield curve?
Yeah, well, there's different ways to take that, right? In the short term, yes, short-term treasuries are a great place to be for that short-term spending kind of cash needs. But when you look at a little bit longer term, you can look at a little more credit plays, right? Investment grade bonds, even high yield bonds are looking a little more attractive because the yield to worst are coming up so quickly.
All right, Benjamin Lau at Aprium, thank you very much. We appreciate it, sir.